Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
Yeah, glad we are...
Glad you're listening.
Yeah, glad to be in the studio with my longtime business partner and financial advisor, Pat McClain. As you know, we've both been advisors for 3 decades or so.
Long time.
Doing this program almost 3 decades. And it's always a pleasure to be with you and help you with as you navigate your finances.
Yes.
And it's funny because we've always said this is an apolitical show, but there's been so much in the world of politics the last couple of weeks. And of course, last Saturday with the attempted assassination and stuff, it's just an interesting time. And then, so we look at last week, and I was kind of curious what was going to happen with the markets.
And
they were on fire.
It is, when the Gaza Strip in Israel, right? We talked about this when it happened, and I thought the markets would just completely tank, and it was like it runs in its own little bubble.
That's the market. It feels like it's been on a melt up.
Oh, the news reports all new highs. You think, well, the markets. That's how it works.
Of course, that's why you invest for an all new high.
The market goes up.
I think
the market goes up 53% of the time, which means it either goes down 47% or stays the same
on each day. Yeah,
on each
in
day.
A typical day. That's exactly right. It's pretty much a coin toss.
Except for that 3 percentage points.
And on annual basis, about 1 out of 3 years is negative. But if you look at the last 12 months,
holy smokes! Yeah, and it's hard.
My wife the other day, I said, "Oh my gosh," and she says, I looked at my phone. She's like, "What?" I said, "The markets are just up so much." She's like, "Well, what's?" They can't. Was it my wife or my daughter? Like, why is this? Why you seem concerned about this? Isn't a good thing? I'm like, yes, I like things going up. I love earnings going up of companies. I love the economy growing. The stock market will follow. But when you have day after day after day, we had a little bit of days here and there, but all in all, the last 12 months, the market has just been. It's just crazy.
What really?
It's normal. This is how the markets work.
That's right. Right.
You could have 2 years of a growing economy
and nothing in the market.
And nothing in the markets.
Or you could have a shrinking economy.
And the market's going up.
As at the beginning of the COVID, right? The very beginning of the COVID. So, but Scott, what's really interesting, is the difference between the Dow and the NASDAQ.
Huge divergence. It's almost like the Dow is irrelevant anymore.
At one point this week, it was 3 percentage points difference. The NASDAQ was down 2.69, and the Dow was up almost 0.3 of a point. And I thought, wow, this is a pretty big swing, right? It's a 3 percentage point difference.
And the last time we had that big of a difference was 25 years ago, 1999.
Yes. It's interesting.
Yeah. I don't know what it tells us.
Well, and small caps, right? Mid-sized companies, small caps seem, they're more volatile but the total market, it screams diversification, doesn't it?
Well, and also just a reminder that you can't time these I don't even know how you would try. Based upon what? You just this week look at it. The Fed comes out and says something. Well, it looks like we might lower interest rates soon, and the market just goes on a tear. And then 2 days later, it's like everyone forgot that the market. It's crazy. But this is how the markets work.
It is how the market.
And so, if the proper allocation for you is to have, let's say, 60% of your assets in growth companies, in equities, in stocks, that should be true now as it was true a year ago and as it should be true a year from now.
Which means,
had you been sitting on the sidelines waiting for the right time,
you really have a lot of angst now because you've just missed out on this, but you still shouldn't be waiting for it to come down.
But we should talk about rebalancing the portfolio. If not this week, Scott, you and I, we should talk about how important rebalancing a portfolio is.
And how fun it can be.
It's really difficult to rebalance a portfolio.
Emotionally,
it's difficult.
Why would you want to sell NVIDIA today?
Yeah, why would you sell something that has done so well? Right? So when you rebalance a portfolio, by its very nature, you're selling those things that have done well and buying those things that have done less well.
Or have fallen in value.
That's right. Which is really difficult thing to do emotionally. And look, we're practicing advisors. I've been doing this for 35 years. When I have the discussion with clients about why we rebalance a portfolio, it is not an easy discussion. They're like, "Why would that, Pat? That mutual fund, that
ETF, that whatever,
is up 30% this year. Why would we sell any of that? Why would you do that?"
And it's during the same conversation. Why do we have this holding in here? This thing lost 8% last year. Aren't you paying attention to my portfolio?
Have you heard that before?
It's funny. So we've been doing this a long time. Years ago, there were a number of years where we did not post the percentage returns of particular holdings because we said, look, there's no benefit to this because people are not going to make wise choices based upon what percentage, just like on a 401k statements, typically, here's how it did the last quarter. And so for many years, we did not have that on our reporting. We do today, you can get all kinds of information and it's all customized reporting now, but
yes,
which I don't know if it's helpful because
it causes people to make emotional decisions and leave. What happens is it can destroy an investment thesis. And an investment thesis, everyone should have an investment thesis. Like why do I own this and what am I trying to achieve?
What are you trying to accomplish and how are you going to go about that?
Yeah, what's my thesis? And then you have to, once you develop that investment thesis, you stick with that investment thesis unless there's been life changes. You win the lottery and all of a sudden you're worth $10 million, or you inherit a bunch of money, or you develop a terminal illness, or. But you can't change investment thesis just because the portfolio is acted in a manner that all of a sudden you think, well, this is doing really, really well. I'm just going to keep it. I was thinking about this today. Yesterday, actually. This one client, she called me. It was in 1990. Do we have any of that music?
You remember this?
I do remember this. She called me and she said, "Pat, I have this stock, and it was a tech stock. It was 1998." And she said, "This is how many shares I have." And I said, "That's worth $1.3 million. I said, "Who gave you this stock?" And she said, "How do you know someone gave it to me?" I said, "Because I know you pretty well. We've worked together for a number of years. You wouldn't have bought this stock because it's not really on your radar and you're not that involved." And she said, "Well, that's interesting. My brother was the CEO of the company and he gave it to me."
This is a late 90s, some .com thing.
It was a .com.
It was worth $1.3 million at the time.
Yes, and the rest of her portfolio was probably worth $1 million. And I said to her, let's
So this could be life-changing to her.
Oh, I said to her, this is retirement money right now. I said, you've talked about you and your husband retiring. I said, this is retirement money. This will get you over the hump. I said, if
you went from $1 million to $2.3 million
in a matter of months. And she said, I said, let's just sell half of it. I said, let's sell all of it and rebalance it and something that's more appropriate for you. And she said, well, I'm not. I'm going to wait for it to double one more time. I said, I think that's a bad idea. So I said, let's just sell at least half. Nope, Pat, we're not selling any of it. 4 years later, we sold that holding for less than $60,000.
Oh,
less than $60,000. And I think about that. I think, this thing fell on you and
you didn't follow an investment thesis about what you were trying to achieve because I didn't help them achieve. That was just, it was the markets overvaluing these .coms at the time, which is, I don't know if you've listened to the show any period of time, this stuff like that kind of scares us a little bit.
Well, I think people get confused on their objective, right? So they suddenly saw this holding that was worth nothing, worth 1.3 million, and they're thinking, if we let this thing continue to run, it's doing so well. Like, why it should just continue to do well. This is such a growth area in the marketplace. This new internet thing, the .com's going to do great. And your objective is like, hold on, we now have enough money for you to live the lifestyle you've become accustomed to, maybe even better than the lifestyle you've become accustomed to.
Forever.
The rest of your life, and not have to worry about your finances anymore. You've got now have financial freedom.
And for them, it went to, okay, let's get rich.
Yeah.
Let's get rich.
And by rebalancing like that and diversifying is not the way to get rich.
Not at, but
it's the way to protect where you're at.
Yeah, it's a good way of not being poor.
Yeah, it's
people get confused. People sometimes think they're interested in getting rich, but really, what most people are interested in is not being poor.
Those are subjective terms, though.
Relative. That's right. Well, since
I think people don't want to go backwards on their lifestyle.
That's right.
I'm not talking like a typical middle class lifestyle.
Yeah, they're not. These people by no means are, driving 6, 7, 8, 10-year-old cars, working for the man, whatever the man, the woman, they. But it's interesting. For whatever reason, when I was looking at NVIDIA stock, I was thinking about that. I was thinking.
What I was thinking this morning, driving in the studio, I remember back in the .com boom, and I remember thinking, it's clearly not sustainable. The question is this going to take down the rest of the market with this, or is this just a one-time thing? But back then, most of those companies didn't have any revenue, or if they had any, it was very small.
Not earnings, revenue.
Just revenue. I'm not even talking about earnings. The difference now is some of these, like NVIDIA, these chip manufacturers, they clearly have both revenue and earnings. The question that, in my mind, is this AI boom, is it going to truly materialize? Are the companies that are investing in this, are they going to get the returns out of this that they were hoping? And are they going to continue to invest in this area? Or are we seeing a bit of a bubble in the investment in these chips?
Oh, in the chips.
Yeah, I mean,
Yeah, in the chips.
Because the bet is that this is going to be transformational. All companies need to get on the bandwagon of AI. If you're not, then you're going to be left behind. So if you're not investing now, I mean, how many times have you been asked, well, what are you guys doing for AI?
Well, now, but AI is it reminds me of the .com where, I mean, I remember a guy coming to, he says, my company's worth $8 million or $12 million, a little investment advisory firm, just super, super small. And I'm like, how could it be there? You're and he had changed the name to wealthmanagement.com or some.
Well, good for him.
Right. It wasn't worth, after the blow up, it wasn't worth anything. But people these companies are not immune to how the markets work and what people are willing to buy. So they're putting AI on everything. Everyone's story is now AI. Regardless of the business.
That's right.
Regardless of the business. I find it's fascinating. Just remember this. When pets.com finally blew up, the biggest asset in the liquidation was the talking hand puppet.
What happened to the Chuck? Is it still around?
It was when they, in liquidation.
But Chewy's a big brand now, right? Chewy.com.
Yes. But it wasn't pets.com.
I know, but it's funny just because you have a good domain doesn't mean you know how to execute a business plan well either.
I find the Chewy thing quite interesting.
Chewy?
Yes.
Why? What do you mean?
I know people that subscribe to it, and they get a box of, magical things for their dogs or cats once a month.
No, I get food. I get dog and cat food delivered. Apparently,
Wait, they don't sell it in stores.
apparently, the dog food that they sell at Kroger's or Rayleigh's or whatever isn't good enough for our dog. I guess I'm not the one who buys the dog food, but I think it's this special. No, fight it.
But I know people that get like a surprise box once.
No,
a month
we don't
for
get a
theirs.
surprise box.
You get dog food. It is really difficult to go to a store and buy dog food.
Hey, I know people that buy all kinds of special raw foods and stuff for their animals. At least my wife's fine with just dry kibble.
From Chewy.
Yeah, it's Chewy. Yeah, Chewy delivers the cat food and the dog food
That's
because they're special formulas. Just
okay.
All right,
We're
let's
gonna get some emails now.
Oh yeah, people love their pets.
Yes.
Yeah.
Yes.
I love my little dog. You haven't had a. It's funny, Pat. When I first met you, you had 2 border collies before you had kids, and then once you had kids, you never had dogs again.
That's right.
I thought for sure you guys would get dogs again.
No,
you never
we're
have
not
got
getting
dogs.
it. We got rid of all the living plants inside my house as well. They're all plastic now. True story. I used to have like 30, and I said to my wife, "This just turned into something else we need to take care of. So let's replace.
Yeah, I kinda
get
get
rid
that.
of them, or it's a plastic."
I have, by the way, and then we're going to get to the calls. We've lived in the same neighborhood, same house, 19 years, and both Pat and I, we live in the foothills of the Sierras, and so there's wild animals. There's lots of deer and
My neighborhood, there's mountain lions.
yeah. And for 18 of the 19 years, the deer did not touch my roses. And we have in the front of my house like a courtyard with like this beautiful roses all around. With probably 25 different rose bushes, different colors. It's fantastic. 18 years, they haven't touched them. Now they're all gone. I was out of town. My wife sent me a picture, a video of this buck, 10-point buck, maybe 12. This thing was
Just
I don't know how old he was. He was just hanging out, laying down. It was a hot day, laying down on the grass after he enjoyed all of our roses.
you hit the deer repellent, spray it on them.
No, I don't know. But to your point, I'm not going to put plastic roses. But I've told my wife maybe we should just put some other plants in there because I don't. How much time
after
am I
the
gonna
show,
spend
I'll
on
tell
it?
you what I use.
Okay, salt pellets.
No.
Just sit out there with a rifle.
No,
I'm tempted to.
Let's go.
All
Let's go
right.
with the calls.
If you want to be part of Allworth's Money Matters and talk to Scott Hansen and Pat McLean, a couple ways to do it. One is send us an email, questions@moneymatters.com. You can let us know what your question is. We'll schedule time to get you on the program. Or you can call 833-99-WORTH and join us that way. We are talking with Ray in California. Ray, you're with Allworth's Money Matters.
Hey guys, how you doing?
Good. How you doing, Ray?
I'm doing great. So I got a question for you. I have to say I have financial freedom. I don't want to get rich. I just want to maintain my lifestyle. And right now I have a pension and I'm doing fine. I'm married. I just retired a year ago and I'm 62. My question for you is, from my ex-employer, I have about $140,000 in a 401k. And my question is, how do I know that this is low risk? Because my goal for this money is just play money. And my thought is I just want to peel off about 10 grand a year and just use that for traveling or whatever.
And how much is your pension a month?
I take home about $7,000 a month.
Okay.
Just in pension?
Yeah, just in pension.
And does your spouse receive a pension as well?
She does not, no.
Okay.
And do you have any cost of living adjustment on your pension as inflation goes up?
I do. I think, I do. It's probably 2.5%, something like that.
Okay. And are you taking Social Security?
I am not. I haven't taken it yet. Nope.
And
But I paid into it.
Are you? And will your spouse receive Social Security as well?
She does not have enough credits or quarters. So.
And are you living comfortably on the net of 7,000? Well, let me ask this question.
He wants another 10 grand.
Yeah, but you're living comfortably on that 7,000.
Yeah, I'm living comfortably. My wife works part-time and she teaches piano, so she has money coming in too.
And when you say safe, what do you mean by safe?
Safe from what?
Okay, so in case the market crashes, am I going to have anything left? So when I look at my 401k, it looks like most of it's in blended investments,
Okay.
blended fund investments. I got like 89% in that, and then 8% in stock and 2% in bonds. So, I mean, is that low risk?
Well, I don't know what the blended is.
Well, I'm going to guess it's
Balanced
probably
fund?
Balanced fund, so 50.
But it depends how you define risk. So here's how I look at risk.
So let's say, let me ask you this. Okay, go ahead. Sorry.
Here's how I look at risk. As the years go on, you've got a pension that has some cost of living adjustment, but inflation's going to, over time, erode the purchasing power of that. So that's how. So I think, is there a chance we can have that 401k set up in a way to have some growth on it to help offset that inflation as the years go on?
Or you could look at risk as fluctuations in the stock market.
Like the 140 drops to 135 tomorrow.
Or 100.
Or 70.
Right.
Right? So what is risk to you?
So risk to me is I don't want to lose it all if the market crash. And if I could get 5% on this money and let it grow and then, peel out $10,000 every year or something and, whatever. For me, it's just play money, but I just don't want to lose it. I don't want to lose like 40 or 50%, if the stock market crashes.
Well, I'm in camp with Scott, which is when we talk about safe, there's two types of safe, right? There's safe that there's no principal fluctuation. And if that's the case, then you could roll it out and put it in an IRA and buy U.S. government bonds, and you'll be okay. It will still have market fluctuations because bonds go up and down in value.
Or you buy CDs.
Or you buy bank CDs. Or
okay.
But the danger there is in an inflationary environment, you will get eaten alive. And so your purchasing power will go down.
You've got a great pension. So one can make an argument saying, you've got such a large pension, let's consider that fixed income. If we actually calculated what the current value of that, what would it cost us in today's purchasing power?
A couple $1 million.
To get $7,000. Yes. So we got all this and guaranteed. We have this little tiny amount relative to the value of that pension. Why don't we have that designed for growth? But and when we talk about a stock market crash, you're not going to go to zero. I mean, if Apple goes to zero and Microsoft goes to zero and Chevron goes to zero and McKesson goes to
your pension goes away because your pension,
our life goes. I mean,
your pension is back. Your pension is backed by about 60% in equities. Your pension and your 401k, if we peeled them back and looked at the allocations, they will look pretty similar. They will look very, very similar because that pension, although it's disguised to you, it's allocated. Most institutional pensions have anywhere between 60 and 70% in equities.
Some private equity.
Some
more
private equity. Some private real estate.
But so there's two ways you can go about this, my opinion. So I'm just thinking, you're my brother. I'd say, look, Ray, here's two options. I'm just throwing out two, there's more than two options. But one option is to say, okay, let's use this, let's keep you happy, not have this thing fluctuate, put it in CDs, draw your $10,000 a year out, defer Social Security until age 70. So let's plan on actually you drawing your 401k down, or at least pulling out the interest and letting the thing not have any growth. And then when at age 70, kick in Social Security.
Then you have a hedge against inflation, at least for a time.
Another option is say, let's invest this if you're going to pull out $10,000 a year, let's invest it the way other pension plans invest it. Let's have a diversified portfolio, maybe 50% in equities, maybe 60% in equities, have some bonds in there and some other parts of the portfolio, designed to weather, just giving you the highest probability that it can continue to kick off income 5 years, 10 years, 15, 20 years from now. And with the shooting for a return north of 5%.
But actually, I think your portfolio is from the little that we can have this conversation without actually looking at the portfolio itself, you've got most of it. My guess is it's between 50 and 65% in equities.
let me throw out a third option. Is you say,
Okay.
carve this into two different accounts. Have one that you put in CDs. You put the exact dollar amount you need to pull out the 10 grand a year, whatever that number is, for the next 8 years until Social Security kicks in. You take the second half of it and you put it in growth investments, realizing that when your Social Security kicks in, you're not going to need that extra 10 grand a month because the Social Security is going to make up for that. And then it gives you a chance for have that other portion of your 401k to have some good growth on it.
And he's just playing mind games with himself at that point in time.
100%.
Right? You're just playing mind games. That's what
Yeah.
you just did, Scott. No,
It's behavioral finance.
That's right.
It's setting this thing up that's going to work for Ray.
And I have done that with clients. I can't tell you how many
I
times.
you want to call it mind games?
It is. But quite frankly, your portfolio is fine.
Yeah. Yeah, I look at my rate of return. Year to date is 9%.
I know, but why?
The 1 year is 13.
But why?
Well, it's because it's somewhat diversified.
No, but why are you looking at the rate of return?
I was just looking at that just for the hell of it, to see how my investments are doing.
Okay.
For my for a 401k.
Okay. But what this is designed for your lifetime.
Yeah.
I mean,
Yeah, no, I agree
in a
with
perfect world, Ray, you step back and you make sure you're invested properly, and then the returns are going to do what the returns are going to do on a short-term basis. Like, who knows if it's going to be up, going to be down. What we do know is if you go over a long enough period of time, stocks historically have done about 7 percentage points above that of the rate of inflation. Bonds have done about 2 percentage points above that of rate of inflation, and cash has done up a 0.5 percentage point above the rate of inflation, historically. The last 100 years, some even say 200 years, depending on how much you want to believe data that far back. But like, assuming that we're going to have something similar over the next 20, 30 years, you could have the approach saying, I'm going to be diversified. I'm not going to worry about the ups and downs. I'm going to have bad quarters.
But
that also takes some mind games.
Yeah, but if you looked at the net present value of that stream of income from that pension, that's fixed income. I would make the argument that maybe this should be 100% equities.
But he's taking some money out.
But he is taking money out.
So you could carve it off saying what money you're going to be, because once you take Social Security, you're not going to need this same additional dollars.
Yeah. So, I think you do what's, if it makes you feel better, do what Scott said. But this portfolio is fine.
Okay.
You're fine.
Well, that's great.
Yeah.
I appreciate your time, guys.
And remember this. You remember this conversation, because in the next 3 years
there'll be a bad time,
and your portfolio will be down 25% in the next 3, 5, 7 years. I don't know when, and you're going to say, "Well, that was really bad advice from Scott and Pat." But look, it's called a risk premium, which is you get above the rate of inflation returns for putting up with that volatility in a well-diversified portfolio.
And I think Ray's question is, why do I bother put up with any of that, right? Why don't I just take the 5% and
Inflation.
Yeah.
That would be our argument.
Inflation.
Yeah. Appreciate the call, Ray. It's it's funny, but investing is not. It's tricky because it's not just the right investments. You need the right discipline behind it.
Yes. You got to get it.
And I see, like I've had, Pat, and you have as well. I've had clients that have multi-millions that say, I've got way more money than I need that I'm going to spend in my lifetime. I might as well be invested for growth. I've got kids and I've got some charities that I care about when I die. Like, let's just invest this thing for growth. I'd rather take on quite a bit of risk because, heck, if the thing falls in half, when we go through the next bear market, it's not going to impact me. I've had other people with several millions that said, Scott, I've got way more money than I need. I'm never going to spend this in my lifetime. Why take any risk whatsoever?
And they're both right.
And they're both right.
Or
as long as people understand the implications of.
Or sometimes you just go right up the middle. You just go right up the middle. And I've done it where I've actually separated the accounts. Like, look, you're not going to spend this money. How old are your children? They're going to inherit this money. Let's invest it for their timeline.
Well, that's just like when I was talking with Ray, saying, let's take whatever you're going to need between now and Social Security kicking in. Let's figure out how much that is on an annual basis, plus whatever interest you'd earn. So if you wanted $10,000 for 8 years, maybe he needs $60,000 in the account or whatnot. And then have one account. That's the whole thing's designed to do.
And then the other,
100% equities, and you just kind of ignore it.
Yeah. Like this isn't, I don't care what it's worth today. I care what it's worth 10 years from now.
Yes.
But that's easier said than done sometimes. That's what makes all this stuff, I think, pretty interesting.
Do you? Well, I'm glad you actually like your job.
I think it's. Look, I have the same struggles emotionally. I mean, it's easy when the markets are going up
Yes.
because you kind of forget how painful it can be when they're going really far south.
Yes. Actually, someone asked me that. They're like, how do your portfolios do? I said, the portfolios do what the portfolios do. It's how the clients react to the portfolios, which makes the job difficult.
Completely. And if we're really transparent here, there's some percentage of clients, I don't know, is it 5%, 10%, 15%, that tend to be the more challenging. And because they're the ones who really struggle staying invested through the market cycles.
Yes. They want a time.
They want another solution other than going through ups and downs.
Yes.
They're looking for some other
get us
solution.
out at this point and then tell us when.
That's right.
But I tell you, Scott, look, there is on my feeds, right, the news things, there are people that market to that class of clients. With the story is we
for
know when to
sure.
get in and when to get out.
Yeah, of course.
Yeah.
Yeah,
We
it's
know
a good
when to get
story.
in, when to
Sounds
get out.
good. Yeah.
This is a good story.
Yeah,
Sounds pretty good.
we're gonna get you. Anyway, all right, let's continue on here. We are in North Carolina talking with Lee. Hi, Lee. You're with Allworth's Money Matters.
Hey, how you doing? Yeah, my name is Lee Johnson, and my question is, I have about 240,000 in 401k, and I didn't know it was best to take it out and pay off my mortgage. It's 100,000, and invest the rest, or what is the best way to go?
How old are you?
I'll be 70 in October.
What's the interest rate on your mortgage?
I knew you were going to ask that. I think it's less than 5%.
Have you refinanced the mortgage in the last 5 years?
No.
Okay.
Well, so a few years ago, when someone had cash invested and they wanted to pay off the mortgage, it made sense from an economic standpoint to pay the mortgage off. Today, for most people, if you've had a mortgage for any length of time, you can earn more, even investing in a CD, something very conservative, have a higher rate of return than what you're paying on your mortgage.
With no additional risk.
Uh-huh.
Yes, no risk whatsoever. You've got something
Right.
that's government backed.
What are you living on? What income do you have coming in?
I got pension about 2,600 and Social Security about the same.
And are you married?
Yes.
And are you taking any income from the 401k?
Oh no, I actually just put it in a fixed place where it wouldn't be affected so badly, just to protect it. And that's been in there for a while. I should have had it in a CD, but
Well, actually, you were on hold. I don't know when you went on hold, but you could hear our other caller.
okay.
I want you to go back and listen to that. Listen to that podcast. Our last caller and you have almost the same identical question.
Okay.
So the answer to your question is no, you should not take it out and pay off your mortgage.
But you could. I mean, you're approaching 70. You've got 240 in your 401k. You're going to have a requirement of distributions coming up here in a few years. Like one idea is just maybe you take what the mortgage amount is and have that taken out of your 401k each month to pay the mortgage. So
you're basically transferring the money slowly out of your 401k against that mortgage, and you're doing it in a very tax efficient manner.
Oh, I didn't know you could do that.
Yeah, well, it's you do.
let's say your mortgage payment's $600 a month or whatever. You say, all right, I'm going to have $800 a month withdrawn. Take the 20%, have it go to taxes or whatever the tax needs to be for you. And then you
automatically goes to your checking account, and then your mortgage automatically comes out of your checking account. So you got the money coming in on Monday and the money going out on Tuesday to pay the mortgage.
Right.
And then
But
effectively you're paying the mortgage using your 401k. I like that idea. I like it a
Okay.
lot. And I think you should have more equities in that portfolio. You should be at least 50% stock.
Okay, so I need to change that, get it out of fixed and put it in like the money, something on the market.
Yes, yeah. It like, look, you need more equity in the portfolio. Scott, you're giving me a look.
Okay.
It's just
It's the investor.
yes. My concern is we say, hey, Lee, you should have some in equities. He moves out of fixed. It goes into equities. We have a 10% correction, which typically occurs about every 9 months, which we haven't had in a while. Doesn't mean we're going to have one tomorrow, but at some point in time, and he's like, what the heck? I
Then
called
he's
these
relying
two
on-
dummies.
Scott, he's relying on the advice of two advisors that are on a podcast, and his ability to stay invested over that down market will be dependent upon how good he thinks this advice is.
That's right.
How good do you think this advice is, Lee?
So I leave it just like it is, and just have the house payment made out of the 401 coming to me. I still be all right.
Yeah, you could do that. I still want some equity in there. I just take $50,000 and put it in the total market.
Okay, I got
Scott,
you.
I don't know.
take 50 grand, put it in the total market, and then pretend that $50,000 is not.
I mean,
part of it.
clearly, your high probability of having growth in this portfolio is not keeping it in fixed like it is right now.
Right.
From a statistical standpoint, you have a much higher probability of having a growth in this portfolio by getting at least some out of that fixed and have it in areas that are going to grow.
And it should be half of it, but just put a quarter in. Just put a quarter of it, $50,000 to $60,000 in the total market, and don't touch it. Just let that thing go. And when you're 85, you will call me back, and you will say, "Hey, Pat, that was brilliant," and I'll forget who you were, and forgot I had a podcast.
Sounds good.
All right, Lee.
I appreciate
the
Thank
call.
you.
It's interesting, Pat. Like as an investment advisor, like one of the most challenging types of clients. Actually, I don't think I've ever worked with one. Is well, I've clearly worked with people that had sudden money, but like a lottery winner, someone who has never invested before. They have a large inheritance. They've never really learned how to live with themselves through the ups and downs in the market, right? So you get somebody to say, all right, let's take you out of this nice, safe spot where the money is, whether it's in a fixed income account in a 401k, or it's sitting in cash, or it's a life insurance proceeds that's in a money market account. And having someone get it out of there that's very stable, that makes money every day, and moving it to an area that's going to fluctuate in value. And I mean, that's why I think it's so important for younger people to have experience as an investor, because they learn through personal experience. It's much more powerful than just reading something.
Yes, but
because we've both had it where we've had somebody, it's kind of new money.
Oh,
They invest it. Based upon our recommendation.
It goes up by 20%. They get super excited, and you're like, just relax.
It goes down. They're calling you 6 weeks later. Why is this thing falling? What's going on?
Yeah.
I trusted you.
Yeah. So when it goes up, they're like, this is the greatest. And a good advisor will tell you, don't get too excited about it, because it will go down. It will go. I promise you, it will go down. Will it go down as less than you started with? Yeah, there's a chance. There's a chance for a period of time, but it goes up and down.
When I was
But what you do is when you sell, you lock in those losses permanently.
you take what's a temporary decline and make it permanent.
That's right.
I remember as a younger man, when in this industry, been doing it a long time, when someone would invest with us, I mean, Pat and I's job, we were both in our 20s,
They called
young
us the boys.
Yeah. Looking back, I'm amazed anyone trusted us, but we're grateful. And those clients that are still with us, we have many clients over 30 years, and
That's right.
very grateful for those people for trusting us. But I remember early on, a kind of standard line was, and part of it's an education process, just like we do in this program. It's really the more you can understand how markets work, the better choices you're going to make, not only on your original investment, but sticking through the markets and sticking with that investment. And I tell people, I said, look, here's the deal. I'm highly confident over the next 20 years, this portfolio is going to work out just as we had planned. It's going to provide that income needs that we've designed here for you. I said, but, and there's going to be some years it's going to grow so much, you're going to think I'm God sent, and you're going to want to adopt me as your own child. You're going to be so tickled pink with how things are doing. And there's going to be some other years that you're going to be so frustrated and angry, you'll be tempted to drive by my office and throw a brick through the window. Unfortunately, I have no idea what the first year's going to be. It might be one where you love me and think I walk on water. Or it might be one you think I'm an idiot because your account has declined so much in value. I have no idea what the first year's going to be, but we will have those years. That's the kind of conversation I would have when someone invests. And a part of it is just getting them to have the right mindset of what to expect.
Which is hard. So we've got longtime listeners that are saying, why are they spending so much time on this remedial stuff, talking about this? Everyone knows this. Look, it is a great reminder. It is a great reminder that this will happen. And the best time to talk about it is when things are going well. Because when it goes poorly, right? Scott, so you used to run these ultra marathons, these 100-mile runs, right?
I ran a 50K with my daughter 6 weeks ago.
So 50K.
And I'm planning on doing, on my birthday in September, I'm planning on running the Grand Canyon rim to rim to rim, which is like almost 50 miles.
And you
I'm back, Pat.
But you're limping through the office.
My oldest daughter's gotten into them, and so it gives me an excuse to.
The point being, when you run these ultra marathons, when you say at 50K, that's 30 some odd miles?
Yeah, 31 miles.
Okay. When you run them at the beginning of the race, do you have a mindset like, okay, this is going to be painful at points in time? Or this is going to be a breeze.
So it's funny. So
it's a mind.
Yeah.
Tell us what your daughter does for a living.
She's a sports psychologist.
Which is what?
Helps people with their mindset.
Okay.
And she works a lot with college athletes or like top high school athletes that are trying to get in the best D1 schools in the country.
And she gets paid for this. She makes a living doing this.
Yes. She's created a little business for herself.
Just helping people have a mindset.
It's all mindset.
Well, there's physical stuff.
Well, fair enough.
But at that level, there's a lot of mindset.
Yes.
Okay. So when you, because I've never, listen, I ran a 10K once. Pretty proud of myself. I did it in 59 minutes.
Well, we talk about it's life in miniature because you go through these. Really, it's a strange thing. And when you've done enough endurance stuff, you learn that your body just goes through these. And you'll go through these segments, maybe it's 20 minutes, maybe it's 2 hours, where you just feel horrible. Nothing's going well.
And you're running. You're not sitting by the side of the road.
Not sitting, you're moving. You might be walking or something, but you're
still
moving. Yeah. And you're these really lows. And then it could be followed by a period of euphoria where you have no pain, you feel more alive than you could ever imagine, and this, and you can have these things within the same hour.
Emotionally,
these highs and lows, and so it's kind of like it's the same thing with life. You have life, you've got these horrible. We all have tragedy that happens and whatnot, and you go through these horrible times in life, and then you go through other times in life when it just seems like everything's so fantastic,
and this too shall pass.
Why did you bring this up?
Because I think that investing is very similar to that, which is when I remember when you did that 100-mile run or something.
Yes, Western States 100.
It took you like 23 hours or something.
23 hours and 53 minutes, I think it was. Because if you make it under 24 hours, you get a belt buckle.
Which I've
never
seen.
That sits in my drawer.
I've never seen it. So, but the point being is, going into each one of the races, you have an expectation of this is how I'm going to feel. So when you start feeling that way, you're like, oh, I'm supposed to feel this way.
It's interesting, Pat, because like particularly on ultra marathon stuff, and I don't do that much anymore, older people tend to do better than young people because they've had that experience, the personal experience. Same thing with marathons. Like you see people at the wall, they talk about the wall. Like I've always thought, what if we just lied to people and when they were at 26 miles, we said we're at mile 20. They would never hit the wall, right? It's like, it's so much, but if you...
Why don't we just lie to the runners?
Just like all of our elites have been doing for us for years, our governments and whatnot. Gaslight everybody. But it's having those personal experiences and knowing that just because you're in pain doesn't mean you're going to be in pain forever. This will pass. And it's knowing how to... It's realizing that you will get through this stage, but it takes.
That's why I asked the question, because it's very similar to investing.
Yeah.
Which is, and the more we could talk about what you should expect, the better the investor you'll be.
Yeah. Well, hey, it's been fun being with you guys today. I hope everyone enjoys the rest of their week. I'm Scott Hansen.
Pat McLean, thanks for joining us.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.